Hi everyone! Lost opportunity. That's what happens when you buy America's most popular index fund without knowing a filtered alternative exists. Same parent company, access to the same 500 stocks, but wildly different selection process and results. Most investors own the classic broad market tracker that holds all 500 companies. Solid, proven, reliable. But there's another fund from Vanguard that applies strict growth filters to those same 500 stocks, eliminating underperformers and concentrating on expansion leaders. Today, I'm revealing this filtered strategy and showing you exactly how to pair it with SCHD to create a portfolio position for multiple market environments. The average trap. The standard 500 company index gives you instant diversification. Apple, Microsoft, Nvidia, ExxonMobil, Walmart, all 500 plus companies in one trade. Simple, effective. But here's what nobody mentions. You're forced to own every underperformer too. Market cap weighting means bigger companies get larger allocations regardless of performance. Every year, roughly half these companies lag behind. Some drag performance down significantly. The fund has no choice but to hold them all. Imagine running a marathon carrying a 50-pound backpack. You'll finish, but wouldn't you run faster without the extra load? The filtered solution. What if you could own only the top performers from those 500 companies? Fire the laggards, keep the rockets. You can. It's called VOOG, the Vanguard S&P 500 Growth ETF. Instead of buying everything blindly, this fund screens using 3 strict criteria. First, revenue growth. Companies must demonstrate consistent sales expansion. Second, earnings acceleration. The fund targets businesses becoming more profitable at increasing rates. Third, price momentum. Stocks must display strong upward movement. Only around 217 companies survive this brutal filter. The other 280 plus get eliminated. Historical results tell the story. Since both funds launched in September 2010, VOOG delivered approximately 16.7% returns annually, while the standard tracker returned around 15%. That difference sounds minor until you compound it over full market cycles. A $10,000 investment in the standard fund over 14 years grows to approximately $70,000. That same investment in the filtered growth version reaches roughly $82,000, an extra $12,000 from one ticker symbol decision. But don't dump everything into pure price appreciation yet. You need ballast, you need stability, you need cash flow. Enter SCHD, the income anchor. While VOOG hunts capital gains, SCHD targets quality distributions through established dividend payers. This fund holds just 100 stocks selected for financial strength. Every company passes rigorous screening, high cash flow generation, strong return on equity, reliable dividend payments for at least 10 consecutive years, and demonstrated dividend growth. Current yield, approximately 3.7%. Compare that to the broad index's 1.1%. SCHD has delivered around 12.5% returns annually since its October 2011 launch. Your $10,000 becomes approximately $35,000 over that period. Not matching pure price appreciation, but you're collecting substantial quarterly payments throughout. Here's the institutional secret. Pairing filtered appreciation with quality income creates portfolios designed for multiple scenarios. When technology surges, your appreciation component captures explosive gains. When markets correct, dividend quality provides stability. You're not betting on one outcome, you're positioned for various conditions simultaneously. The math breakdown. Real example. Invest $10,000, split 60-40, 60% in VOOG, 40% in SCHD. Over a typical 10 to 15 year period using historical returns, your $6,000 appreciation component could grow to approximately $35,000 to $40,000. Your $4,000 income portion reaches roughly $11,000 to $14,000. Combined portfolio value, $46,000 to $54,000. Plus, you collected hundreds in quarterly cash distributions. Compare that to putting everything in the standard tracker reaching $70,000. The filtered combination delivers competitive total returns, but with critical advantages. balanced exposure, regular cash payments, and risk management across two strategies instead of one blended approach. When appreciation tanks 30% or more during sell-offs, your income holdings typically fall only 10 to 15%. When income underperforms during tech rallies, appreciation compensates. The portfolio balances itself through market cycles. 3 non-negotiable truths. Accept these realities before investing. First, filtered appreciation carries significant volatility. Recent severe market downturns saw the standard index fall 18 to 20%. The filtered growth version dropped over 32%. If witnessing your account down 1/3 triggers panic selling, this approach isn't suitable. You need minimum decade-long horizons and discipline, ignoring short-term noise. Second, you're concentrating heavily in technology and expansion companies. VOOG allocates roughly 43% to technology. Nvidia alone represents over 13% of holdings. If technology crashes while value stocks dominate future cycles, you'll underperform significantly. That's the explicit trade-off for concentrated positioning. Third, costs and taxes matter. The filtered fund charges 0.10% annually. Income Quality charges 0.06%. Both beat actively managed alternatives, but exceed the standard's 0.03%. On $100,000 invested, you pay approximately $80 yearly versus $30. Additionally, income distributions create taxable events annually in non-retirement accounts. The filtered growth fund generates minimal dividends, providing tax efficiency. SCHD distributes quarterly, triggering annual tax obligations. Plan accordingly based on account types. Everyone claims dividend investments suit only retirees, but when filtered appreciation crashed 32% recently, SCHD holders collected 3.7% yields while systematically buying discounted shares. Who actually won long-term? Ideal candidate profile. This strategy fits specific investors. You need minimum 10 to 15 year timelines before accessing funds. You must handle significant volatility without emotional reactions. You want both capital appreciation and cash flow rather than choosing one exclusively. You believe American innovation and quality dividend companies will continue long-term positive trends. You're willing to implement slightly more strategic allocation than pure set and forget passive indexing. The 60% appreciation allocation captures majority upside exposure, while 40% income provides sufficient cushion during downturns. The reality check. Let's be direct. The standard broad tracker isn't wrong. It's proven effective for millions of investors. Simple to implement, for pure simplicity seeking maximum diversification, it serves perfectly well. But adding one strategic layer, splitting between filtered growth appreciation and quality dividend income, provides something the standard alone cannot deliver: specialized positioning for different market environments simultaneously. The 500 company benchmark represents average by definition. Can we systematically exceed average without excessive risk? Yes. You separate concentrated appreciation through growth filters from defensive income through dividend screens. Implementation roadmap. Here's execution. Already own the standard tracker? Don't liquidate everything triggering capital gains taxes. Direct new contributions towards building filtered appreciation and income quality positions gradually. Starting fresh, consider 60% filtered appreciation, 40% income quality from day one. Establish automatic monthly contributions maintaining these allocations. Rebalance annually using this system. If any fund exceeds target allocation by more than 10 percentage points, sell the excess. Use proceeds purchasing whichever fund fell below target. This forces selling high, buying low automatically. For example, if VOOG surges and reaches 70% of portfolio value, sell enough, bringing it back to 60%. Use those proceeds buying SCHD at lower valuations. You've locked in appreciation gains and purchased quality income on sale. Financial media won't promote this because it's not sensational. Doesn't promise overnight wealth, but it's precisely what disciplined wealth builders implement, beating market averages while managing downside exposure. If this revealed a more strategic approach to index investing, subscribe and enable notifications. I analyze practical implementations that build lasting wealth without hype. Comment below, sticking with the standard, trying this split strategy, or using something different. For educational purposes only, this is not financial advice. Consult a qualified financial advisor before making investment decisions. Past performance doesn't guarantee future results. This is InvestED, building wealth the boring way that actually works. Smash that like button and subscribe for strategies Wall Street won't tell you. Investing smart, profitable investing.